Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Court Cunningham, CEO of Orchard, a company that helps home buyers sell their homes before they buy their next home. Court, it's great to have you with us. Welcome back to Trade Talks.
Thank you. Great to be here.
What's happening in the housing market right now? When I look online, it feels as if there's not as many listings as when we met earlier in the year.
So it isn't. So listings are up. Inventory is up from earlier in the year, but there is a shortage of new listings coming on market, and the reason is there is what we call the lock-in effect. So it's an amazing stat. 85% of homeowners have a interest rate on their mortgage below 5%, and we're today at 6.3, 6.4. And so if you're a discretionary mover, you're not going to move. And so while the market is soft, inventory isn't growing as fast as we would have normally expected.
What about mortgage rates? How are they impacting buyers?
So it's really interesting. Buyers were undeterred for the most part through the summer. So as the mortgage rates went from 3% to low fives, not a big impact on demand. And then when Powell did his "I don't care how bad the recession is" speech in August at Jackson Hole, and mortgage rates went to 7% in like a 10-day period, that was the straw that broke the camel's back. And so we've seen, consumers are very skittish about buying right now. It's it's 30% more expensive to own a home today than it was a year ago. Good news is, prices have been coming down slowly since May. May was the peak, and rates are actually down. We're at, as I said, like 6.3% versus the peak of 7. But our view is it's going to take most, if not all, of next year for things to calibrate. We think that rates will probably stay around 6 because if you look at, like, a lot of people who are in their early 30s say 6% mortgage rates is crazy. If you look over 100 years of history, the range is 4 to 6%. And there were two anomalies. One was the great inflation of the early 80s, and the other was the last 14 years with all the Fed intervention. And so our view is we're probably going to be around 6, and housing prices will calibrate over the next year.
Right. Well, let's talk about that. Do you think a housing crash is likely as we think about a global recession? Because this does not feel like 08, 09 to me at all.
Yeah, we think it's very, very different. So, 08, 09 was a supply crisis where lots of people with ninja loans and couldn't afford, things were overbuilt. There was too much supply. Today, it's the opposite problem. There's actually too little supply. There are 10 million millennials who are, kind of 28 to 34 prime nesting age who are still renting. They're all going to buy homes over the next 3, 4, 5 years. We are not overbuilt. Home builders didn't go crazy, and credit standards are really strong. I mean, think what you want about Dodd-Frank and all the reforms, it actually has dramatically improved the quality of the loan book out there. So what's happening now is a demand shock where it's more expensive to own a home, and that's pushing people to the sidelines. So we don't think a crash is at all likely. It's just going to be a slow deflation.
Right, and that's why it doesn't feel like 08, 09 now that we have regulations in place when it comes to lending, when it comes to the banks. You don't have that systemic risk, so that's why it feels different to me anyway.
100%.
So what buyers do you think are likely to enter the market? You had mentioned millennials before, but they're priced out.
Yes and no. I mean, so look, there's so for first-time buyers, yes, but for second-time buyers, meaning I have a house, there's still record home equity in people's homes, and so there's a real wealth effect from that. And what we also see is that about half of people moving are must-move movers. I've got a new job, or my kid is going to a new high school and I want to be in the good school district, or someone in the family died. And so we do think that while transactions are probably going to be sub 4 million transactions next year, we're about 4.5 this year. We were 6 last year, 6 million. That's still a lot of home transactions. And so, yeah.
So remind us again how Orchard fits in the housing market ecosystems and the solutions that you provide, because you're known for helping homeowners buy their next home before they sell, and that's kind of where the supply issue is. They're afraid to sell because they're not sure if they'll find something to buy.
Yeah.
So what solutions are you providing?
Yeah, I mean, so Orchard, really, you can think of us as e-commerce for home buying. We've integrated real estate brokerage, title, and mortgage, so everything's in one place, and it makes it super easy for you to transact. And then the second thing that we do is we will front you your home equity out of your old home, so you can buy first, and we guarantee the sale of the old home. So in the tight market of the last 2 years, having that cash to buy the new home was really valuable. That's less important today. but having the certainty of the guarantee on your old home is really valuable in this uncertain market. And so, but that's what we do. We basically take the friction out of the process.
And I notice on Orchard, you're in very specific markets. Is that by design?
Yeah, we're in mostly Sunbelt markets, places where there's good kind of macroeconomic tailwinds to growth and housing fundamentals. Over time, we believe we'll be a national business. Like we will launch in New Jersey and Connecticut at some point over the next 5 years. Florida and California are next on our list, although in the current environment, we're kind of sticking to our knitting until things stabilize.
All right. Appreciate the insight as always, Court. Thanks for joining us on
Jill.
Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.